Hi, everyone. Thanks for being here today. We've got a lot of folks joining us, so we're going to give them a few minutes and then we'll log a few minutes to log on and then we'll get started. See you in a few minutes. All right. Hello, everyone, and thanks for joining us today for our Q2 interest rate webinar. For those that recognize my voice, I'm Sarah Conklin, co-host of the Rate Guide podcast, and as JP loves to say, the real boss here at Pensford. Before we get started, here are quick housekeeping notes, just a few things before we get going. The recording and presentation slides will be sent out to everyone after the webinar, so be on the lookout for those. We'll also be doing a Q&A at the end, so be sure to put your questions in the chat, and JP will answer a few of those after we're done. And now, without further ado, here's the man who, on a long enough timeline, is always right, JP Conklin.
Thank you for that very warm intro. And I usually say during these presentations that I have a wife that likes to remind me that I'm wrong all the time. So I appreciate you acknowledging that I am right from time to time. Why don't we just jump right in? You know, obviously we always start with a very brief commercial here. We try not to talk our book too much, but for those of you who have been enjoying the newsletter or the podcast or these webinars, but who have not yet worked with us, please reach out, give us an opportunity. We love working with you guys. Since the last webinar, Pensford actually turned 15, so many thanks to those of you who have been along for that journey. For LoanBoss, you know, a newer company that we started a few years ago, many thanks to those customers as well. And we've included a QR code that takes you right to a 3-minute demo, so you don't even need to book anything with us. As always, the main lesson with both these companies is these are relationship businesses. So we appreciate building relationships more so than working on transactions. As always, shout out to the real experts out there. You should follow these guys way more than you follow us. Call out a couple specific ones. Bloomberg, Anna Wong and Ira Jersey are spectacular. SMBC, I've been highlighting them for several webinars now. SMBC really upped their game a couple of years ago by bringing Joseph on board. And then last but not least, the Federal Reserve. Like if you go to any of those Federal Reserve websites, it's pretty spectacular information. And you'll see a lot of that cited in here. But all of these are people that we really enjoy following, and we suggest that you do as well. Before we dive into the economic stuff, just thought maybe I'd give you a really quick overview of what we're seeing in the market. Cap margins are extremely tight, way tighter than they were for the last 2 years. We are back to 2016, 2017 levels. Part of that is, banks have just compressed their pricing. A lot of that is due to 5 to 6 banks are in an auction nowadays. That takes me back 10 plus years since I saw that consistently. Replacement cap escrows for those Freddie borrowers, we're seeing those essentially reset at no incremental increase. So I think there's going to be a lot of relief on the escrow front there. Some of the hedges that we're seeing, people have gotten pretty creative. We're seeing prepayment hedges. So if there's a defeasance or yield maintenance and they're worried about rates dropping between the time it's signed to the time it closes, we can help hedge that. Same go in the other direction, rate lock hedges. If you're a week or two away from being able to rate lock and you're nervous, you can execute a hedge. We even had one customer do what we called a rate lock remorse hedge, which is they just believed the minute that they locked, rates were going to plunge. And so this way they got to benefit if rates fell in the 30 days after they locked. We also have customers buying out floors who believe that rates are going to come down faster than the market currently expects. They're very cheap right now, so we've seen a lot of tick up in activity on that front over the last probably 2 months, as well as construction hedges. Tons of construction hedges. I think it's mostly because lenders didn't used to require that. I'll point in the bottom left there, the market share. So we saw Wells Fargo really steal a ton of market share from SMBC. Wells Fargo basically got their desk up and running, started getting hyper competitive, and was beating SMBC most of 23. You can see the difference between the two is only about 6% at year end, most of which came from a surge by SMBC in December. That had there not been that surge, it would have probably been closer to sort of 50% Wells Fargo. Like they just had a huge year. SMBC has responded and they've gotten hyper aggressive with their quotes again. And that's why you see some of that inequality across the different banks. But we're still able to run an auction like we were able to 15 years ago. So we're seeing a lot of price compression on caps. With the strikes, they really haven't changed that much over the last couple of years based on what people are buying. What has changed is the Freddie requirements are up tremendously. So you're seeing Freddie run their tests and you're able to see a much higher strike there. That has helped with costs. Unfortunately, if you bought a cap, you close on a Freddie loan, the resets are still pretty expensive. I just thought it would be interesting to highlight what we're seeing from an activity standpoint. We tend to trail brokers by about 30 to 60 days, which makes sense. They're closing on a loan. We kind of come in on the tail end. So their activity picks up about 2 months before ours. January and February were pretty quiet for us. Then it started picking up, and then the last couple months have been pretty busy. So I don't know if that's a general thawing. I don't know if that's going to continue for the rest of the year. I just thought I would share it with everybody. One sentiment I have heard is even though people don't really expect the election to impact much around a transaction that they might do or a decision, they do think that it'll impact sort of liquidity, the month or so ahead of time. So a lot of people are maybe rushing to do something now before that liquidity dries up, and maybe that's what we're seeing here. You'll note in the transaction type, the cap volume, pretty much everything that we're working on is extensions at this point. We have a handful of other things, but that's far and away the most common thing that we're working on. Also interesting to note, non-bank, generally I think of these as debt funds, making up a huge percentage of the overall volume. And we spend a ton of time with brokers, and they seem to be echoing the exact same sentiments. So I thought, with us getting ready for the summer, we would focus on school's out, school break. Our kids just finished up. And whenever I see this quote, I always think of the Alice Cooper song, School's Out for Summer. Probably doesn't match with this picture, but that's what I think of. And as I think about the Fed's dual mandate, I go back to 22 and all I can picture is this seesaw. You've got the unemployment rate and you've got inflation. The unemployment rate's very low and the inflation is very high, right? And so they basically want to sit somebody like me, one of the heavy guys, on that inflation seat and see if we can bring it down without ejecting the poor guy on the unemployment rate seat. we have seen a pretty good job overall of these being brought into balance. They're much more even keeled than they were a couple of years ago. And I think what the Fed is trying to do now is maintain that balance. They're shifting their focus away from inflation and starting to move into monitoring the labor market a little bit more closely. As you'll see there, and maybe a lot of you feel this way, that's how I feel after 2 years of rate hikes. I'm ready for the first cut to get out of the way. We had a Fed meeting last week, and as I usually do, I schedule this after the Fed meeting so that I don't say something stupid that they end up making me eat right after a webinar. So I kind of cheat and just schedule this for right after. Couple of things to note. Powell said that they had the CPI data in hand that morning, but most members did not update their forecasts. That is shocking to me. And I think the fact that he said that means he's maybe a little frustrated that they didn't update their forecast. The only defense I can think of them having is one number is not going to make me change my forecast. Now, I would say that feels a little fishy to me because you guys were all overreacting to the Q1 CPI data. Why all of a sudden you get that number that morning and can't be bothered to update your forecast, especially with something that is this crucial. It does make me think there's potential for a more volatile swing the other direction should the CPI and PCE data continue to come in a little bit underwhelming. The other thing that stood out to me was that he noted the possibility that non-farm payrolls are being overstated. Now think about, I've been talking about this for 18 months. I brought this up at NMHC 18 months ago and was adamant these numbers are not as legit as they seem. And here we have a Fed chair actually addressing that at one of his press conferences. And so I do think it's something to pay attention to. And it also suggests to me he's at least aware of the possibility, even if he's not yet convinced that that is actually happening. Main takeaways is they sort of reduced the median cuts from 3 to 1. Had one more person said 2, it would have been 2 instead of 1. It's not that big of a deal. They're still largely on board that they are cutting this year, and we'll talk a little bit more why. What I did find interesting is they're still expecting a point of cuts next year and a point of cuts the year after, and the ultimate landing spot being 3.1. That feels a little low to me relative to everything we're seeing now, but there's no doubt they're still expecting a pretty substantial reduction in interest rates. In this table, what you're looking at here is essentially how much did this change from their other meeting? So these projections are only updated every other meeting. And so in here, you can see they raised core PCE 0.2% to 2.8. Well, we're already there. We're actually at 2.75. And when Powell was asked about this, he said, yeah, it's a pretty conservative number. Plus, I think we're sort of baking in the basis effect, which is essentially a math equation. Anytime you're measuring something from the prior year, once it starts moving fast, then it's tough for the number year forward to actually move much. So he's basically suggested because inflation fell so much last year in the second half, it'll be tough for it to fall again this year. I'm not sure if that's entirely true, but I think that it's fair to say I could see it leveling off and maybe not gaining as much momentum. To assume that we're not going to see any progress feels a little unrealistic to me. Same thing with unemployment. This is a weird number to me. We're already at 4%. They're literally suggesting no change in unemployment through year end, which feels a little weird when we're seeing all these other signals about the labor market that we're going to talk about today. And then here's we've put in 2 more, or we've removed 2 cuts this year. Now we think we're still going to finish north of 5%. Oh, excuse me. What I put down here is these numbers are largely where we already are. There's no margin for error here. It is really odd to me that this is where they landed at with all of these. They're essentially saying there's no change, and in some cases, really no change for the next several years. And I have to wonder, how much effort are they actually putting into this if they're unwilling to update it the morning they get CPI, which is a primary driver of their forecast. But look how much unemployment barely changes, and even PCE stretching out over the next couple of years. It just feels a little odd to me. And so as we hear them speak and they talk about higher for longer and we're not cutting anytime soon, last year we had that slide that got a lot of publicity where we sort of showed what they were saying right before they ended up cutting because they do a really bad job of signaling cuts. And I thought, why don't we just take the people who are talking today and compare this to some quotes that they were making a few years ago before they started hiking. And the one that jumps out at me is Kashkari. He was an uber dove heading into 2022. And the reason I remember him saying this is because I wrote a newsletter on him calling inflation ghost stories. Like there is no more inflation. Inflation is not a thing anymore. I was in that same camp. I had egg on my face. He's now saying, "Hey, we're not cutting this year, essentially, right? Or if we do, it'll be at the very end of the year, December." It's just funny to watch these guys. I think there's a chance he might just be positioning to run for Fed chair after Powell's time is done. I think the other one that jumped out at me was Bowman here, where he's basically saying the risk that inflation remains persistently above 2% is small. And now he's saying, I'm willing to raise the target range. I'm still willing to hike at this point. So just take everything that they say with a grain of salt. I'm not sure how accurate any of these quotes are going to be, but I do think if we keep seeing inflation come in cooler than expected, or at least moderating, that they're really going to be taking their cues from the labor market. What is interesting to note is that they're really not changing their sort of neutral rate forecast at all. It has ticked up ever slightly from 0.5 to 0.7. And so you can see that over here. It went up from 0.5 to 0.7. I don't know how much stock I put in that. What it does tell you is they still think that they're going to be reducing rates pretty substantially. This is sort of the neutral rate where it neither encourages or discourages growth. When you want to translate this to Fed funds, you add inflation to it. So if you think inflation is, let's say, 2%, then you would say, okay, they're at 0.7, I'm at 2, that's 2.7 is kind of the landing spot for Fed funds. If you're in the camp of, no, we're never getting back to 2, or it's going to take forever to get back to 2, inflation is really 3. If you believe this R star number, what you're saying is, I think the ultimate landing spot of Fed funds is probably 3.7. My personal take is R star has climbed somewhat. Inflation is probably not going to be 2, maybe it's going to be 2.5. The ultimate landing spot is likely sort of 3-ish, maybe 3.25. I'm not in the camp that it's 4%. I believe it's well below 4%. We just haven't seen all the monetary policy tightening work its way through the system, which is interesting to note here. So I got popped in the nose by a Charlotte Fed economist 2 years ago. March 22, they were just starting to hike, and I said that, hey, I'm skeptical that you guys are going to be able to raise rates 3% without breaking something. He walked me through their thinking. It was sort of my warning shot that, oh, they're going to be hiking a lot more than I realized. But one of the things I asked him was, do you guys have any concern that you are trying to fight a supply side issue with a demand side tool? Right? Rising interest rates don't really affect the supply side. They just affect this demand side. And he said, absolutely, we're concerned. But when all you have is a hammer, that's what you got to use. And what's interesting to me is this blue represents things that respond to monetary policy. So this is the things that would respond to that hammer. Look how effective the hammer has been. Pretty darn quickly. They started hiking in here, and pretty darn quickly that hammer has worked, right? Now look at the red, which are the things that are not that responsive to monetary policy. Very slowly moving, right? Now this will probably continue to move lower, but it'll be way slower than the progress we saw on interest rate sensitive things. Now, to me, what that suggests is maybe the Fed is right about R star. Maybe it's not really going to be climbing that much because it does seem to work. The minute they hike rates, things cool off, right? And that's what would drive that. The other thing it suggests to me is I'm not sure that holding off on cuts is going to help that much, that this is being driven by things other than rates at 5.5%. So why leave them there? Why run the risk of breaking something if these aren't really going to respond to that anyway? So that takes this graph I've been showing you guys for at least a year now, this concept of breaking action. This is what the Charlotte Fed economist really drove home to me. Once Fed funds is above inflation, you now have breaking action on the economy. And his point to me back then was, hey, listen, when we're hiking here, we're not applying the brakes. This is us taking our foot off the gas, but we are not applying the brakes until these two cross. It took a year for them to cross. Now they've crossed. You can see the Fed leveled off. And once the Fed leveled off and inflation kept falling, the braking action got bigger and bigger and bigger. And this is why the Fed is going to have to cut this year, because this is going to continue to widen as inflation keeps coming down, and it's more and more breaking action on the economy, and that runs the risk of breaking things. So I've been saying all along, I think the market is underestimating the possibility of a July cut because the Fed will have June's inflation data walking into that. What if inflation is 2.6 at that point? What if it's at their year-end forecast in June? What if unemployment's at 4.1 or 4.2? At that meeting? How do they justify not cutting at that point? They're seeing things cool off pretty rapidly. Their statements recently would suggest they're not cutting in July. And I think most people believe they're not cutting at all this year. I am definitely not in that camp. But I do think they have to cut because this breaking action is going to really start to impact the economy. Notably, the market's still pricing in a pretty good chance of a cut in September, and then a 91% chance that we're sub 4.5 year-end 2025. What's interesting about that, and the reason I included it here is, I spend a lot of time talking to brokers, and I've kind of asked them, let's just pretend that rates are down 75 basis points across the curve, Jan 1, and they just stay there. How much does your activity increase? And the pretty consistent answer, depending on asset type, is around 40 to 60%. So let's just say 50%. It's pretty dramatic. So the people I speak with seem to think things will thaw out rapidly if we can just get to this 4.5-ish number. Even 4.75 probably on Fed funds, probably sub 4% on the 10-year Treasury. I think both of those are happening at some point in the next sort of 6 to 9 months. Also interesting to note, the Fed is not going to wait for inflation to get to 2% to start cutting. They're going to cut way before that. They don't project inflation hitting 2% until 2026. So they do not need to be at 2% in order to start cutting. Keep that in mind. I think it's maybe one of the most under-discussed topics right now. The flip side to this is we've seen precedent where rates can stay positive, real rates can stay positive for an extended period of time. If you go back pre-financial crisis, it lasted a couple years. Now, they started falling pretty rapidly heading into the financial crisis. This is probably like Bear Stearns collapsing in July of 2007. But it was a pretty consistent climb, right? And we're sort of experiencing the same thing. We're starting to level off. This is that breaking action on the economy. And I'm not sure how long they can maintain that before they need to start reducing it. The good news is they can cut 10 times. If inflation stays currently flat, they can cut 10 times before they're pressing on the gas pedal again. That is a ton of room to sort of ease off the brakes. One cut here, another cut there, another, and just sort of ease into it and see how it goes. That sets the stage for what is arguably the only soft landing they've ever achieved, which is sort of 94, 95, when they hiked a bunch and then backed out 75 pretty quickly, right? I could see us taking 75 basis points out in the next, sort of 6 to 9 months and extending that rally. But this cycle came with 6 years of positive real interest rates right up until that recession hit. That's where that dot-com bubble hit. So as much as I would love to think that they're going to be cutting to get positive real rates back down, the precedent is, hey, we can survive for a while at these levels. One thing to note on the term fund program, this is the thing I was saying at the last webinar, like, hey, let's keep an eye on this. If these banks are not repaying these balances, it's a worrisome sign about the health of the banking system. As a quick reminder, they closed it off March 15th. And so after March 15th, no new loans were being made. And so we started tracking it saying, okay, well, they started these loans March the prior year. These loans now have to get repaid. We should start to see a drop off. And we did. And so for the first couple of weeks, I'm out there telling people, hey, these are good signs for the health of the banking system. There might be some knock-on liquidity effects where banks maybe pull back on lending appetite because they're paying back so much of this, but at least it's not a sign that there's an underlying issue that we're having to deal with. And then something funny started happening. The balance stopped dropping as much as it should have. So this is the actual balance, and you can see it's been much more shallow. This is what it was supposed to be. And so there's only one way that this can happen, and that is the banks who owed money here reborrowed before March 15th. And they just said, you know what, we've got that loan coming due in May 24. Let's reborrow today so that we can use that money to repay this loan when we get there. And we won't actually have to negatively impact our balance sheet, which suggests to me they need more time to deal with some stuff, right? Probably some of it's real estate related. But at this point, we have 40 billion outstanding more than we should have. And like to joke, if you threw 40 billion at Pensford, things would feel a lot better than they do too, right? So 40 billion comes up a lot of issues on bank balance sheets. This program ends March of next year, and then we will have a list of banks who were borrowing, right? Right now they're on the clock. They're trying to shore up their balance sheets and clean all this up before that happens, and they're no longer anonymous. And so I believe that this year's focus is going to be, or the second half of this year's focus is going to be shifting from inflation to jobs. So going back to the summer vacation vibe here, for those of you who are around my age, you probably remember these slides. They're probably outlawed at this point. These things were over 8 million degrees in the middle of the summer. And so this is inflation in 2022. You ride down this super hot slide. We're in 2024 now. You get to the bottom of this thing, it's now 10 million degrees, but you sort of leveled off. And this is this last mile of inflation. And if you're on this actual slide, you had to kind of scooch off while the skin was melting off of you. I think what the Fed is worried about now is unemployment spiking because they're driving inflation down, right? The measures it takes to get inflation down to 2% could be pretty painful and drive the unemployment rate up. And so Powell's going to be very sensitive to this going forward. That I think he's probably going to be willing to live with above target inflation for a while, several years, if it means protecting jobs, right? And we went back and looked and said, okay, over the last 30 years, how often were we between 1% and 3%? You know, we just picked that randomly. It's 88% of the time, right? And we're there now. And so it suggests like we're kind of back within a reasonable band that he's probably willing to tolerate above target inflation for a while if it means he's not making Americans lose their job, right? Now, when we get to the far side of this, they will probably ditch the 2% target, right? I think that he wishes he didn't have that hanging over his head now. He's stuck with it. He can't change the rules in the middle of the game. But if you look at their other mandate, the labor mandate, they do not target a specific unemployment rate. Instead, they just say full employment. I would not be surprised to see them adopt something that says just something generically like ensuring price stability. And then you can take that to mean whatever it means. Real-time measures of inflation, the Fed has several, Bloomberg's got some, there's a lot of them, all suggest inflation is going to continue to moderate. That's why I'm a little confused by the Fed's own anonymous forecast, despite what they say about the base effects. So these are intense models. These aren't just like people filling out a piece of paper. And you can see this is the New York Feds. They've got inflation at 2, 2.1, 2.2. This is the Cleveland Feds. This is the one I go to most frequently, Inflation Nowcast. They're expecting this next one to come out at 2.6, right? That's what the Fed is projecting for year end. And their own models say we're going to be there this month. And then last but not least, Bloomberg also has one, also projecting that the next print's going to be coming in lower. So I just think the Fed has maybe boxed themselves into a corner. They're so data dependent that when they give us numbers, what do they do if those numbers come in lower than what they suggested? Because if they said that, hey, we're willing to cut 1 or 2 times this year, if we get to 2.6, what happens if we're at 2.6 this month? It suggests that they might be cutting a little bit more than they realize. That brings me to one of my favorite people in the universe, JMO. I know a lot of people have asked about him. He has agreed that if he loses this wager, I can unmask him. Until then, I'm protecting his privacy. People in Charlotte absolutely know who JMO is. And we've got this wager on core PCE. Maybe 3 caveats I'll give you about JMO. Number one is I've known him for like 20 years. They were literally my first client ever at Pensford. Their contract is still hanging up in a frame behind me. So we're very tight. He is extremely bright and inquisitive. He loves talking stuff out. And maybe most importantly, there's no way he's out of bed before 1 o'clock. So that's why we do this webinar at 1 is I can talk a lot of smack about him and he won't even know that I'm doing it. We made this wager. And this wager was based off my very first day at the Wachovia trading floor. Because at the end of the day, I'm hearing these traders debate over who was ESPN's #1 athlete of the century, right? Now, this is pre-internet. We had internet, but it was like that dial-up. It took 60 seconds for it to work. And so they're just arguing. And it's basically Babe Ruth or Michael Jordan. Now, I knew it was Michael Jordan. I knew it to my core. And so I piped up. And this is day one. I should have kept my mouth shut, but I piped up and I said it was Michael Jordan. And so the guy betting on Babe Ruth says, how much you want to bet? And I said, any amount. Now, that was the dumbest thing I could have said. And to this day, I'm grateful that he only said $100. But in that moment, $100 was essentially infinity because I don't think I had it. I'd been there for 1 day. I am now stuck on my first day on the trading floor trying to decide, what do I do? I can't back down. I'll look like a coward. So I said, you're done there, because I'd learned that's what you tell people when they're done with the trade. So I say, you're done there. He says, done. It's now locked in. And I can hear another trader hitting the dial up and it's starting to spin up, and you hear that sound. If any of you are my age, you remember what that sound is. And in that moment, I'm thinking, I'm not entirely sure it's Michael Jordan anymore. I'm starting to get nervous. My palms are sweaty. Finally, I hear somebody say, it's Michael Jordan. And I just like collapsed. I was so grateful that I was right. The trader, much to his credit, gets up, walks over, just takes out $100, lays it on my desk just like that. I didn't know people carried around hundreds. And he walked back, didn't talk about it again, and that was it. So my lesson there was, don't ever open your mouth on a trading floor unless you're willing to put money on it. And the lesson I still impart to my team today is, that's how you express conviction in a position. If you believe you're right, you'll put money on it. If somebody's just popping off at the mouth and isn't putting money on it, it means that they don't actually believe in it, right? It's part of the reason I love real estate people is they all are putting their money where their mouth is. JMO was popping off at the mouth, as he is wont to do. And he's been doing that for as long as I've known him. And I had just had enough. And it was clear to me he was just ignoring everything I was saying. And I finally tried to put him into a trade. And my initial trade was 4%, right? I thought maybe I could bait him. And he didn't bite. So then I said 3%, and he did bite. So he gets 3% or above for core PCE this year. I get 299 or below. As you can see here, here's the update. It is definitely moving my way. I think the average is right around 2.84 maybe. And looking pretty good for me. Now, I had not expected during these first 3 months that they were going to increase the shelter component weighting, which would hurt me, right? And so these numbers were not as low as they should have been. So I don't have the lead I thought I would have at this point, but it's clear it's moving my way, and we would need to see a pretty sharp rebound in order for me to lose at this point. So I'm going to continue talking smack. Someone asked me, would I let him out of the trade at this point? Like if 80 cents on the dollar, and I was like, no way. I want to spend the next 6-7 months making him twist. And this is one of my favorite movies of all time. Even though it's not really about summer break, it is about skipping school. And in a lot of ways, JMO reminds me of Ferris Bueller because he kind of coasts through life with that. Unlike Ferris Bueller, totally unwarranted. He's got that swagger, hasn't really earned it yet. And I'll be anxious to see how he responds at the end of the year when he has to pay up on it. My thesis for this was almost entirely shelter component. But that shelter component lag is huge and is just working its way through the system. This blue line is new tenants, right? Look how much faster that fell off a cliff than the gold line, which is owner equivalent rent, right? Now, in this case, owner equivalent rent really bothers me as well, because this is a question that they ask homeowners. And they say, how much would you rent your house out? This question is taken right from their website. If someone were to rent your home today, how much do you think it would rent for monthly, unfurnished, without utilities? I don't have the slightest clue, because I'm not about to rent my house. And we've been there for 10 years. I have no clue what I would rent it for, right? And I do know that if you made me sit down and think of a number, I'm probably not changing that number next month when you call me back. You know why? Because it's not a real number. I'm not being forced to clear the market. So who cares what this number is? This question is 25% of CPI. That makes no sense to me, right? This is not a question that should be driving monetary policy decisions, yet here we are. The interesting thing to note about inflation is it has been improving dramatically over the last 2 years, right? I think maybe we've gotten a little bit spoiled by the move from 3 down to 2. It feels like, hey, it's taking too long, but let's just remember a year ago at this point, the Fed thought we would be at a full point higher than we are. So we're still way ahead of schedule. So I have 2 graphs here. This one's from the San Francisco Fed here, and this is supply is the green. Yellow is kind of ambiguous. They're not really sure. Blue is demand. Demand has fallen faster than supply. We now have more of a supply inflation problem than a demand inflation problem. Again, going back to the hammer analogy, right? You might have seen last month, car insurance made up a huge percentage of inflation, right? If you look at the super core CPI print, which is kind of like one of Powell's favorite things, car insurance by itself was almost half of the entire number. And so let's use that as an extreme example. Imagine that inflation is at 2.8 and just refusing to budge, but the only reason it's refusing to budge is because of car insurance. Do we really have an inflation problem, or do we just have really high car insurance and that's just going to take some time, right? I think we're so focused on the overall inflation story, we're starting to lose perspective on things that 10 years ago we wouldn't have called the car insurance thing an inflation story. What did you say? Car insurance is really expensive. Bloomberg has this awesome graph where they track how many underlying components are growing at a certain pace. Look at the share of things that are growing. The prices are going more than 3%. These have fallen off a cliff. Now, it's still just under 40%. It's still a sizable number, right? But it is plunging at this point. Conversely, things that are growing at less than zero, in other words, deflation, right here, not disinflation, but actual deflation, is the fastest growing segment, and they're about to cross, right? Give this another couple months, I bet they will have crossed. Certainly by year end, they will have crossed. We will have more components of CPI that are deflationary than that are more than 3% growth. Not even 1% or 2%, more than 3%. The thing that is probably the stickiest right now is wages, right? If you look at this graph up here, they are plunging. So this is what part of the reason why I just am not buying the labor market being as strong as people think it is. But note here that we put the dotted line at 3%, not at 2%, and that's intentional, right? So they are moving. They're still above where they're supposed to be, but they're coming down. 3% is the Mendoza line because that's the number at which most economists believe we result in overall inflation of around 2%. So we really need wage growth to come down even further in order to get back to this number. It's like between 3 and 3.25, kind of backs you into an overall 2% number. So inflation continues to be sort of the sticky part. Here's another graph. The gold is labor, right? As you can see, it is far and away the stickiest part of all this stuff, and it's just not moving that much. And I can understand why, because people are buying the labor story. They just think, okay, this is the strongest labor market we've ever seen in our lives. I feel like I'm beating the dead horse because I've been talking about it for 18 months, but I just do not trust these numbers. One of the things that we look at is trends that would identify a potential recession. And we looked at non-farm payrolls, right? So I don't love this number to begin with, but there is a pretty high correlation with non-farm payroll noise and a recession. So these are absolute numbers and surges in either job gains or loss. It kind of doesn't matter, but they're always centered around recessions, right? And so you will see a ton of noise going into or coming out of a recession. It's not great at predicting them though. Look down here, right down here, we're like, hey, listen, what this suggests is pretty predictable. The numbers are coming in pretty consistent. Everything's okay. That's what people keep saying. And what I would say is, yeah, but look how vertical these lines go. Once the labor market breaks, it breaks fast. The only time we see these things jump without a recession is a soft landing of 94 to 96, right? But even then, the labor market still behave that way. So what I would say is, yes, I agree that today's labor market is not recessionary. What I would challenge people is just be careful because this can change at the blink of an eye. That it wasn't that long ago, we might be looking at here, or we might be looking at here, or down here, right? And then we're off to the races. Keep that in mind as we talk about the labor market. Now, I am not an immigration expert by a long shot, but there seems to be a developing consensus that part of the reason that we've seen such continued strength in the labor market without the typical trade-offs that we're accustomed to is immigration. Look how much net immigration has played on the overall population growth over the last couple of years. This pre-pandemic estimate number, this top line here, think of this as, if we have any baseball fans, the Mendoza line of like sort of the break-even point of job gained each month in order to not be contracting. Okay, I think a lot of people sort of assume zero jobs gained is sort of that break-even point, and that's not true because we are adding people each month. And so really, most economists today sort of say around 100,000. We don't know what the precise number is, but we believe we're adding about 100,000 people to the labor force each month because they're turning 18 essentially. If we get less than that, if we get 90,000, it's slightly contractionary. Zero is quite contractionary. So this is the number. Look how this number is probably being adjusted if we account for immigration. It is substantially higher. It's at least 2x what we thought it was in the past, which suggests, hey, we can absorb a lot of this workforce without it being inflationary, right? It's part of the reason, everybody feels so good about the labor market. Things are changing now, right? So this is the quits. Maybe you heard some people talk about the great resignation. That's kind of become the great stay. This is happening, right? People are not quitting their jobs because they do not feel as good about their chances, and there aren't as many job openings as there used to be. This is corrected pretty quickly, and we're actually below trend, right? That is a worrisome sign. This is probably the most important slide in the whole thing, and there's a ton going on, right? Well, I'll walk you through this as best I can. First Friday of every month, we get the jobs report, and it's actually two different surveys. You've got the establishment survey, which is they call establishments, companies like Pensford, and say, how many people do you have on the payroll, right? You tell them how many. They do not ask how many hours did those people work. So if I had 30 people working 1 hour and one person working full time, that would be the same as 31 full time people, right? So it is questionable quality at best, right? This is what leads to the non-farm payroll number. The other part is the unemployment rate, which is also called the household survey. And this is where they call it households. And they're more focused on the actual people. Are you employed or not? I don't care if you have 5 jobs. I don't care if it's part-time yet, but they do ask the follow-up question. Do you have multiple jobs? Is it a part-time job? Is it a full-time job, right? That leads to the unemployment rate. For whatever reason, for my entire career, non-farm payroll is the number that gets printed. This is the number that Powell said, hey, there is maybe some discussion being had right now about whether or not this number is overstated. And here's why. This number keeps coming in higher than expected. It keeps getting revised, and people are like, why is this the case? And then why do we keep falling for it month after month after month? What was most notable last month was not the fact that government and healthcare accounted for 50% of the job gains, because that's how it always happens. What was notable is that 231,000 of the 272 came from an estimate called net birth death adjustment. Now, if this isn't your first time on one of these, you know birth death is not being applied to people. It's being applied to businesses. And they're talking about businesses being born or businesses dying and the resulting jobs gained or lost from that, right? Quite a mouthful. But this is a giant percentage. This is 86% of last month's number was from this random estimate. And last year, more than half of all of the non-farm payroll gains came from this estimate. This is questionable. And the reason I know it's questionable is because the household survey is telling a totally different story. It would be different. I would feel totally differently if they were in sync. They're not, right? If you take the household survey, it says on net, we lost over 400,000 jobs last month. In no universe would we be screaming about how strong the labor market is if that had been the headline instead of 272. But because we've always just talked about non-farm payrolls, that's the number that gets reported. This is the number that has me spooked. And even if this number's overstating it, it suggests there's so much noise here, we have to be mindful to not put too much stock in the 272, right? Part of the reason all this noise is happening is because the response rate to these surveys has dropped from 70 to 30%. Who here wants to answer a phone call from an anonymous number, and then if the person on the other end says, I'm with the federal government, keeps talking on that phone call? People just are not responding to this yet. We're trying to extrapolate the same amount of data quality from it. So I've said this before, I'll say it again. I do not blame the statisticians at the BLS or the BEA. I blame us for not digging into the data a little bit, right? Now, the question is, hey, shouldn't there be a more accurate measure of this? And the answer is yes, we have it. It's called the QCEW, the Quarterly Census of Employment and Wages, right? This thing tracks about 95% of all jobs. That's what this blue thing took straight from their website. Says what they do, right? Except it comes with a giant lag. It's a 6-month lag. So the last data point we have is September 2023, right? From September 22 to September 23, this showed 800,000 fewer jobs than non-farm payrolls. Non-farm payrolls is overstated, period, right? On a monthly basis, it's overstating between 60 and 80,000, right? In that one period, it's about 65,000. Would we all be talking about how strong the labor market is if we subtracted 65,000 from every single month last month? I don't think so. In fact, Dr. Anna Wong, Bloomberg's chief economist, believes that the true non-farm payroll number is less than 100,000 a month. This is a troublesome sign because if the Fed keeps rates higher for longer, based on the labor market strength or the perception thereof, it means they're going to misfire and it's going to lead to problems. Now, after that last report, we got 272. I get this text from JMO, jobs is jobs. He's lecturing me that I'm too in the weeds, right? And I just disagree with him, period, right? I made a snarky comment in the newsletter and the podcast that week, like, I guess all landlords are landlords, right? JMO, all owners are owners, right? government healthcare is making up a higher and higher percentage of overall jobs. If you strip this out, which is just using taxpayer dollars to either fund directly or subsidize pretty heavily, the job market is not nearly as strong as otherwise suggests. And this is a recent trend. This hasn't been going on for 10 years. We're talking about we went from 10% 2 years ago. We're coming from government and healthcare to now 60%. This is not a signal of a really strong labor market. We also went back and said, well, maybe we can identify some sort of correlation between part-time jobs. Again, JMO and I disagree on this. He believes part-time jobs are totally fine. I think that they are not as high quality as a full-time job. And what we found was, in general, once you see part-time jobs surging, it ends up having a recession, right? And so you can see a decent correlation. This is the only one that didn't, but that's just because they changed the numbers that year. Otherwise, there's a decent correlation, enough to at least put me on guard. I will continue to believe that most of these job postings that everybody talks about are phantom. This company did an analysis, and what they found was if you went back 5 years, there was about 100,000 gap between sort of what was out there and what was actually being hired. So you could allow for some noise at that point, but they were tracking pretty closely. And then it has widened dramatically. It's now about 450,000 different, right? These job postings are not real. So when you hear people talk, Powell says this and drives me nuts. He talks about the number of unemployed people relative to job openings. I would say that's bogus. That there are phantom ghost job openings out there that are making people believe that these exist and they don't in reality, and that the job postings the real ones are probably much slower. I suspect they're about 100,000 over this, and this line should be way down here, which would then change the narrative over how many unemployed people do we have, or how many job openings do we have per unemployed person, which is a measure of labor tightness. So if you're picking up what I'm putting down, it's basically I'm getting pretty nervous that we are increasingly all in on the strength of the jobs market. This is a real picture from Carowinds, which is just outside of Charlotte, last year, making headlines because somebody videotaped this crack, and in the video you can see it actually shaking. So it is actually shaking while people are riding this thing. And I'm just wondering, okay, what's going to happen to consumer spending as that jobs friction continues to build? Now, people say, hey, listen, consumer spending is still strong and still moving quite strong. I would say, yeah, but consumer spending is 2/3 of GDP. What happens if we take one of those away? What happens if we start losing jobs or people run out of credit card debt? It starts getting a little wobbly, right? The helicopter money is gone. This is from the San Francisco Fed. We have inverted since March, right? You can see it didn't take long for us to start spending it more than we had in the first place, but it took a while to run through $2+ trillion. We're now negative. That's going to continue to weigh on consumer spending, particularly for low-income earners, which has led me to this conclusion of, I'm calling this a spending sentiment because I think most people generally are negative on the economy as a whole. And yet for themselves, they haven't really changed their spending habits. They're still buying cars. They're still taking vacations. And so if I just call this a spending sentiment, both high earners and low earners are sort of feeling pretty good, but it's for different reasons. The high earners kind of have a weak labor market. There's not a lot of shifting going on. Here's some white collar job postings. You can see they have fallen off a cliff on the Indeed job posting index, right? But that is offset by the fact that they are asset owners and their net worth is up a bunch. And so psychologically, they feel okay. They haven't started losing jobs yet, so they feel okay. Conversely, the low earners also have a high spending sentiment, except it's really rooted in the labor market. Their job openings are probably pretty decent, right? This is where me and JMO disagree. They can bounce around between jobs, but their net worth is lower than it was pre-COVID. And that's what you're seeing down here, is that the trend is not their friend right now. And so they are all in on this labor market remaining strong. If that labor market starts to show cracks like that Charlotte roller coaster does, things could start to pull apart pretty quickly. And so here, we've been tracking some of what retailers have said because we feel like they're probably more boots on the ground than a lot of the economists. There's this fun Big Mac index that the Economist started in '88, tracks pretty well with CPI. McDonald's came out this most recent quarterly earnings and said, hey, we're getting nervous, right? There's an old saying that the best cure for inflation is inflation. I think we're starting to see that. McDonald's is citing that. They're not the only ones. Starbucks, Macy's, Best Buy, a whole host of others are saying things are happening. That picture is one of my buddies up in the Hamburglar at the McDonald's. back when that was where you threw birthday parties, right? The thing you probably don't see is all the parents standing around smoking, because that was still considered okay back then. Now, this is one of the things that JMO would point out to me. He'd say, hey, listen, but the debt to income ratio still seems reasonable. People are still paying their debts. And he's right, right? That if you look at this debt to income ratio, it's actually doing reasonably well. Now, total debt has surged dramatically, but the actual debt to income is doing okay because wages are up and stuff like that. Here's the thing, debt to income is by definition a math equation. And if income becomes zero, the equation breaks, right? So we are all in on that number not being zero. And if it starts to become zero, we start having a real problem. I think it's already starting to happen with delinquencies, right? So here you can see, look how much non-mortgage interest payments have surged vertically since the Fed started hiking. People are only making their payments because they still have jobs. The minute that starts to wobble, we're going to fall behind. We're seeing delinquencies across auto loans, credit cards, all starting to tick back up. The only one that's not miraculously is student loan, which apparently you don't have to pay back anymore. Must be nice. I wish I had taken out more student debt. This leads to good spending. Okay, this is GDP. This is where we keep hearing about how strong the consumer is. I don't believe so. It is declining pretty rapidly, just as their borrowing rates are peaking, right? These things are starting to converge. I don't know if you guys saw, but rates are down today, and that's because retail sales missed. And retail sales, just think of them as like a proxy for consumer spending, which is what leads to GDP. Big miss, right? People are pulling back. It's starting to happen pretty quickly. This is, again, why I think the Fed will be cutting. And so this takes me to this wheel of death. Anybody who's in my age bracket who maybe works with some Gen Zers and you hear them describing things as like a triggering effect, and you're like, what is that? Why are you guys always describing triggering effects? The feeling you just got when you saw that picture of that little merry-go-round is a triggering effect. And we all remember, because we would cling on to dear life, because if you threw off, there was a pretty high chance you were going to die, right? I think consumer spending, consumers are basically just clinging to those jobs as they're twirling around, the credit card debt's maximizing, sentiment's down because inflation's up, and they're just clinging. And man, if they lose the job, they're going to come tumbling off. So that leads us to this RV trip that we took in 22, much against my will. That is the actual RV that we drove. I think this is one of our sons trying to start a fire. I was just like pacing because I was trying to get out of there. It was over 100 degrees. Our AC had broken before we even got to Fort Worth, but we had driven from Charlotte to San Diego. It was pretty brutal, right? Before we did, someone said, hey, you should go watch that movie, RV. And we did, right? I wish we had watched it before we had booked the trip, because we probably wouldn't have taken the trip. But in that, Robin Williams plays the main character. Here he's getting steamrolled. And what I'm pointing out here is that other countries are already starting to cut. We're usually the first one to move, and in this case, we were not. The ECB already cut. UK is likely to cut. And we're seeing other countries in the G7 already starting to cut. So it's probably going to keep gathering momentum. On this heat graph that Bloomberg puts out, you can see all the blue is countries that are cutting, right? It's starting to happen. We won't be able to detach for that long. Now, I think 10 years from now, we won't know whether it was 3 months or 6 months. That'll be a blip. But I suspect it will be a drag on our rates, particularly the fixed rates, right? And so here's a graph just showing you how they're starting to diverge as we move forward. Don't be surprised if this becomes a theme in 2025. The demand for our debt is still pretty strong, right? I think a lot of people are worried that the stimulus, the fiscal deficits, the massive issuance is drying up demand, and it's not really the case. We're still about 2.5 times what they're issuing, right? So if this was down around 1, then we would have a bigger problem, because that means we only have 1 buyer for every dollar out there, and that's not the case. We have 2.5 times. We remain the world's mattress. Now, that being said, we have a liquidity problem, and an increasing liquidity problem. And this is why the Fed is intervening a little bit more aggressively, right? And they're doing that through 2 ways. Number one, they're tapering quantitative tightening, and they're basically stepping down how much they're allowing to roll off each month. This should alleviate some upward pressure on yields, right? That had been putting some upward pressure, let's call it 25 basis points, allows them to drift lower than they might have otherwise been able to. The other thing, and we talked about this last year, and I'm a little surprised it's not getting more publicity, the Treasury is buying back Treasuries. They're calling up banks up to $2 billion a week saying, we will buy your least liquid Treasuries, just give them to us, And I believe they're doing it with sort of this tacit understanding that the banks will then go and bid on the new treasury issuances, which then drive up the demand, right? So can you imagine if the government called you and said, hey, listen, we want you to sell us your least liquid properties as long as you promise to redeploy that money into a new sort of like mission-centric, multifamily complex, right? That's kind of what's happening with treasuries. So of course the demand for treasuries is pretty strong. And so that leads us to, like, I'm still convinced that we will have rate cuts. I know I thought we would have them in June, May or June. We haven't, and I don't think that they're going to happen in July, but I also think that's because we're overreacting to flawed data. Cap pricing has been relatively flat for the last couple of months. Will probably continue to be so. Unfortunately, they surged. This is Powell's pivot. This is when they bottomed out, and then they surged again, and we're kind of here. We're probably not going to see it drop off until we get to a point where cuts are being priced in. So unfortunately, we just kind of keep watching and waiting and hoping that they come back down. I still think this is probably 3 months out before we see a nice drop. Now, the good news here is the inverse is true, that if you believe rates are going to be falling, buying a floor is pretty cheap. Look how much cheaper it is than it was in December. So it's basically the opposite reason the caps are expensive. Now floors are cheap. This would be the time to buy a floor if you believe in that thesis. 10-year Treasury is pretty range bound. I don't know that I expect a ton of movements until we have more clarity around what the Fed is going to do and inflation. Longer term, by the end of the year, I think jobs are going to be driving it. I put up some key resistance levels. You can think of, like, if you're bouncing between these numbers, it takes something to get you out of that. There's a catalyst that gets you out of that. So we're rating here. It's going to take some sort of catalyst, an outlier number or Fed speech about something. Something along those lines is what causes those to break. Otherwise, they hold up pretty well. Once we break through, like if we were to break through 435 because we got some really hot numbers, 435 kind of becomes the floor, and now 462 is the ceiling. So my second half outlook for this year is on the floating, lower and slower, continued. Cuts will likely be determined more by labor than inflation. Keep an eye on the labor situation. I think that will become the main thing that the Fed is looking at because inflation is largely contained. I still think we're having 3 cuts, but I can understand why people believe it'll be 1 or 2. I think we'll probably have 4 cuts next year. I don't think we're going to get as low as the Fed thinks. I think it's sort of more shallow as we move forward. On the fixed rate front, lower, but that's really based on a slowing economy, right? Not cuts. So if the Fed starts talking about cuts, don't assume the 10-year is going to respond 1 for 1. It's probably more is, well, why is it cutting? Are the wheels falling off? Or is it just a nice, slow, soft landing, in which case 10-year is really not going to move that much lower. Remember, the Fed is projecting Fed funds to be at 310 in 2 years. So that is a lot of cuts, but that is based on unemployment at 4.1 and inflation at 2. We're basically already there. This feels like there is a tremendous amount of error that could happen from here on out because everything they're doing is based on this perfectly soft landing. If that landing ends up being hard, fixed and floating rates could end up being much lower, particularly the fixed, because the floating, they're already projecting getting down to 3. The fixed, the wheels could fall off and we would see a sub, 3.5, 3.25 at that point. They're trying to avoid this situation over here. And then last but not least here, everyone's a tough guy until Americans start losing jobs, right? I think Powell keeps talking about inflation and that there will be some pain in the labor market. I'm not sure how much he can tolerate if unemployment starts climbing. If it goes to 4.5 this year and they thought it was going to be at 4, I don't know how much he'll cling to that narrative as we move forward. So wrapping up here, monetary policy school's out for the summer. I believe that since the Fed is overreacting to Q1 CPI, they are ignoring the most recent data, which they admitted a July cut is probably off the table, even though it shouldn't be. So with that, I will dismiss class for the summer, except for JMO, I would like for you to report to summer school for some additional math and critical thinking skills. I'll take a look at the clock. Oh, we've got 2 minutes just coming in under the wire. I don't know if we have time for questions, but I'll open it up, Sarah.
Yeah, I think we have a couple. And also I had a physical reaction to those playground equipment pictures. So appreciate that. So first question, if rates drop 75 bips, what do you think happens to transaction volume?
So that I would go back to what the brokers are telling me, which is it jumps dramatically. Depending on asset type, probably 50%. But I think if we see 75 basis points come out of the rates in general, we're all going to be pretty slammed next year.
All right, number two, French bond yields jumped 80 bips in one day. What is the likelihood of that happening here?
It's low if Biden wins. It's not zero if Trump wins, because basically what they're experiencing over there is panic about whether or not they will pay their bills. And I think that would be one of the unsettling aspects is there any possibility that we just stop paying our bills? And that's why we saw their 10-year jump 80 basis points. If that becomes a fear here, then we will see it. I don't believe so. I believe the institutions will still require that we make those payments, but it would be the sort of thing that would cause that.
You're calling for a slower economy. What do you think our chances are of experiencing stagflation?
I think they're pretty low. Powell got pretty cranky about that, not at this most recent meeting, but the one before. And I'm in agreement with him that stagflation doesn't occur when inflation is at 2.8. That's what you have when it's like 10%. If you go back to like 72, inflation was 10, unemployment was 10. That's when you can experience stagflation. It's tough to have that when unemployment's at 4% and inflation is sub 3%. So I would put a low probability at that.
It's a popular one. Will the election influence Fed rate decisions?
So Powell got really cranky about that topic as well. Also not at this one, but the prior one, which makes me think that he's really trying to stress that it will not. And I suspect in large part it will not. But that doesn't mean that it won't influence it at all. I think Powell's preference is he doesn't have to make a decision around the election. Like he would love if he did not have to do that. It's part of the reason why I still think he will move before the election is kind of squeeze one in and then let things settle before we get to the election. But he was adamant that the Fed will not factor in the election into any decisions that they make.
We've got two more. Will the curve uninvert this year?
It depends on how much they cut. If they cut 3 times, then it could. If they cut 1 or 2 times, then probably not. There's really no precedent for the curve uninverting without a decent number of cuts. So I believe it's certainly on the table. But if the Fed is right and they only cut once, then no, it will not uninvert this year.
All right, we're going to end with a little sports. Are the 23-24 Celtics the greatest NBA team of all time?
Well, I could put that back to you because I suspect your answer as a beloved Bulls fan is probably the 94-95 Bulls. Clearly not. And what really pains me is I hate all Dallas teams so much, and yet I would have picked Dallas to beat the Celtics because I just hate the Celtics even more. So my Sixers continue to break my heart. But Celtics had a great season, but they're not better than the mid-90s Bulls. No way.
Zero chance.
Zero chance.
Before we end, I just want to reiterate that we will be sending out the slides and the video recording after this. So no need to email. They will be in your inbox shortly. And that's all I got on my end. Anything from you?
Nope. Thanks, everybody. Talk to you in 3 months.
Thanks for joining us.